Okay. So good evening, Yumi. Coming back to the next topic, accounting standards. Accounting standards. First of all, what is meant by, in this lecture, we are going to discuss what is meant by accounting standard and what is the procedure for issuing the accounting standard and which body issue the accounting standards in India and the list of the accounting standards and applicability of the accounting standards, and then we discuss two accounting standards. Okay, this is today's lecture. So coming to the accounting standards, these are the written documents. Accounting standards or the written documents issued by government. So these are the written documents issued by government with the support of regulatory bodies like MCA. So MCA stands for what? Ministry of Corporate Affairs and National Financial Reporting Authority. National Financial Reporting Authority. So these are the written documents issued by the government with the support of regulatory body. So generally coming to the transactions and events of an accounting, so generally we need to standardize the recognition of the transactions and events, and we need to standardize the measurement and the presentation and the disclosure aspects. Then only we get the qualitative characteristics of the financial statement. For that purpose, to uniform the all accounting policies followed by the to uniform the all accounting policies to be followed by the accountant while preparing financial statements. So some standards issued by the ICAI through the government so those are called as what? Accounting standards. So accounting standards are nothing but these are the written documents issued by the government with the support of the regulatory bodies, like MCA and National Financial Reporting Authority. National Financial Reporting Authority. So by considering four elements, four elements, that is, first one, recognition, and the second one is measurement, third one is presentation, and the fourth one is disclosure of those transactions and events in the financial statement. So accounting standards are nothing but these are the written documents issued by the government in support of some regulatory bodies like MCA and National Financial Reporting Authority. By considering these aspects, recognition of transactions and events, measurement of the transactions and events, and the presentation of the transactions and events, and the disclosure in the financial statements. Then coming to the next one. So coming to, first of all, how the accounting standards are issued. How the accounting standards are issued in India. So generally, here accounting standards are framed by ICAI, Institute of Chartered Accountant of India, and it established one body to frame the accounting standards, nothing but ASB, Accounting Standard Board, Accounting Standard Board, ASB. So ASB identify the area where the accounting standard required. So first of all, it identify the area where accounting standard required. Accounting standard required, and give that area to the study group established by accounting standard board. So in that study group, so there are n number of members, like so members from ICA are there, members from CMA, and members from ICSI, and members from MCA, and members from banking sector RBI, members from SEBI, etc. So by combining the all members from the different bodies, one study group was established to frame the accounting standard. Then they conducted some research, they obtained the information relating to the respected area, and they prepare one drafted document. Study group prepare one draft relating to the accounting standard. One draft relating to the respected area. Relating to the respected area. Relating to the respected area. Then that was provided to the ASP. That was provided to the ASP, Accounting Standard Board. Then Accounting Standard Board so finalized the respected draft and issued to the members of various industries by way of accepting the comments on the draft. By way of accepting the comments on draft, whether the draft contains whether the data available in the draft is correct or wrong. So whether the data available in that draft is useful or not, whether policies are followed by the followed in that draft are in compliance with so all industries or not. So those are considered. So the draft finalized and issued to the groups various groups by way of accepting comments, by way of accepting what comments. Then the comments provided by the members of the respected institutes, respected industries, then those comments are considered. After considering the comments, the final draft prepared and issued to the council of ICAI, to the council of what? ICAI, then accounting standard released on that area. And once the accounting standard release, it sent to the MCA. It sent to get the approval from the Companies Act 2013. Once the accounting standard get the approval from the Companies Act 2013, those are called as notified standards. Those are called as what? Notified standards. So this is the process how the accounting standards are issued in India. So generally accounting standards previously issued by ICAI. So later ICAI established one body for issuing the accounting standard, that is nothing but ASB, Accounting Standard Board. So ASB identify the area where the accounting standards are required. And so then, and that area provided to the study group, which contains the members from the various industries, members from the various industries or various institutes. Then they prepare, they gather the information relating to that area. So in terms of what, so how they are considered in terms of what is the objective of that area, and what is the scope of the respected transaction and event, and how to recognize, and how to measure, and how to present, and how to disclosure. So these all elements are considered. By considering these all elements relating to the particular area, they prepare one draft. They prepare one draft, and that draft, that exposure draft, provided to ASP. Then ASP finalize the respected draft and issued to the respected members of the industry by way of accepting comment. Then after considering the comment, the final draft sent to the council. Then council issue the accounting standard. Then accounting standards sent to the Companies Act for the approval. Then that is said to be our notified accounting standard. Notified accounting standard. So generally, accounting standards issued by ICAI are applied for non-corporate entities. Are applied for non-corporate entities. If the accounting standards are required to be applied to the corporate entities, it has to obtain the approval from MCA or Companies Act 2013. Then those are said to be what notified accounting standard. Notified accounting standard. So this is how the accounting standards are implemented in India. How the accounting standards are implemented in India. And he clear next coming to the what is the applicability? What is the applicability? What is the applicability of the accounting standard? Coming to the applicability, coming to the applicability, so to the corporate entities, nothing but what companies, and to the non-corporate entities. To the non-corporate entities. So generally corporate entities, so those are based on the applicability, those are classified into the two categories. Sorry. Small and medium scale of enterprises, SMEs, and non-small and medium scale of enterprises. Small and medium scale of enterprises and non-small medium scale of enterprises. Coming to the non-corporate entities, those are classified into the four categories: level 1 enterprises, level 2 enterprises, and level 3 enterprises, and level 4 enterprises. Level 4 enterprises. So here these applicability are issued by ICAI, and this is as per the company's rules. As per the company's rules. So here applicability as per non-SME and as per level 1 both are same. And the rest of the three, level 2, level 3, level 4 is relating to the SME. Level 2, level 3, level 4 is relating to SME. So generally, level 1 enterprises are treated as large enterprises. Large enterprises. So level 2 is treated as medium enterprises. Medium. And level 3 are treated as small enterprises, and level 4 is treated as micro enterprises. Level 4 are treated as micro enterprises. So these three at present are covered under MSME, micro, small, medium enterprises. For these enterprises, accounting standards are applied from the level 2, level 3, and level 4. So these are covered under what? SME, small and medium enterprises, as per the company rules. So then coming to the applicability, so level 1 enterprises. Level 1 enterprises. So level 1 enterprises contains what? So level 1 enterprises contains the non-corporate entities. So those entities whose shares or securities are listed or in the process of listing, either are listed or in the process of listing in any stock exchange in India or outside India. So entities whose shares or securities are listed or in the process of listing in any stock exchange either in India or outside India are covered under what? Level 1 enterprise. Next, it includes banks, financial institutes, and entities involving insurance business. Entities involving what? Insurance business. Here banks including cooperative banks. Banks including cooperative banks. Then entities whose turnover except other income in preceding financial year exceeds 250 crore rupees, exceeds 250 crore rupees. Entities whose turnover except other income in previous financial year exceeds 250 crore are covered under level 1 enterprise. And whose borrowings entities whose borrowings including public deposits at any point of time in preceding financial year at any point of time in preceding financial year exceeds 50 crore. So what is that meaning? For example, in the last year, so entities total borrowings, so at the end of the year is around 28 crores. At the beginning of the year, 30 crores is there. At the end of the year, 28 crores is there. During the year, company obtained around 45 crores loan from the bank. 45 crores. Then what is the opening? 30 plus 45, 75. Out of that, some balance was repaid. At the end, we have around 28 crore. Then don't consider the balancing figure at the end of the year. Verify throughout the year at any point of time if the borrowing exceeds 50 crore or not during the preceding financial year. At any point of time, if the total borrowing exceeds 50 crore, then that entity is covered under what? Level 1 enterprise. But coming to the turnover, we have to consider the whole turnover during the year. So the total turnover during the year exceeds 250 crore. So then that is covered under level 1. But remember, while calculating turnover, don't consider what? Other income. Don't consider what? Other income. Next. holding and subsidiaries of the above. Holding and subsidiaries of the above. So these are covered under what? Level 1 enterprises. So level 1 enterprises are nothing but entities whose shares or securities are listed or in the process of listing in any stock exchange in India or outside India. And banks, financial institutes are entities involving in insurance business and entities whose turnover in preceding financial year exceeds 250 crores and the entities whose borrowings including public deposits at any point of time in previous financial year exceeds 50 crore and holding and subsidiary of the above are treated as what? Level 1 enterprise. Clear? Level 1 enterprise. So remember, these level 1 enterprises are also treated as a non-SME. Non-SME. So for non-SME also the same conditions are applied. Then coming to the SME, so there are three categories: level 2, level 3, and level 4 as per ICI. So coming to the level 2. So level 2 enterprises. So entities whose turnover in preceding financial year. Entities whose turnover in preceding financial year exceeds 50 crores but less than or equal to 250 crore. So 50 crore to 250 crore. 50 crore to 250 crore. The entities whose turnover in preceding financial year exceeds 50 crore but not exceed 250 crore. But not exceed 250 crore is covered under level 2. And entities whose borrowings including public deposits exceeds, including public deposits exceeds 10 crore but not exceeds 50 crore. And remember, at any point of time in previous financial year, at any point of time in previous financial year. So here for level 2 enterprise, so what is the turnover limit? 50 to 250 and level 2 enterprises total borrowings is 10 to 50. 10 to 50. 10 to 50. Then the third one is holding comma subsidiaries of the above. Holding comma subsidiaries of the above are covered. Clear? This is about what? Level 2 enterprises. Then coming to level 3 enterprises. So entities whose turnover in preceding financial year. Entities whose turnover in preceding financial year exceeds 10 crore, exceeds 10 crore, but not exceed 50 crores. Exceeds what? 10 crores, but not exceed 50 crore. And entities whose borrowings including what? Public deposits at any point previous financial year, at any point in previous financial year exceeds 2 crore, exceeds what? 2 crore, but not exceed 10 crore. And the last one, holding and a subsidiary of above. Holding and subsidiary of above. So coming to the level 1 enterprises, level 1, turnover exceeds 250 crore. Borrowings at any point in previous year exceeds 50 crore. Coming to the level 2, turnover exceeds 50 but not exceed 250. Borrowings at any point in previous year exceeds 10 but not exceed 50. Coming to the level 3, turnover exceeds 10 but not exceed 50. Borrowings exceeds 2 crore but not exceed 10 crore. Set to be level 3. And the final one is level 4. All other entities. All other entities which are not covered in the above 3. Which are not covered in the above 3. So these are level 1, level 2, level 3 and level 4 entities. So here level 1 is said to be a large enterprises, and level 2 is said to be a small medium enterprises, and level 3 is said to be a small enterprises, and level 4 is said to be a micro enterprises. So as per the Companies Act, so level 2, level 3, level 4, these are covered under SME, small and medium scale of enterprises. But level 1 is said to be a non-SME, so not a small and medium scale of enterprises. This is the whole applicability pattern relating to the company. Whole applicability pattern relating to the accounting standards. Accounting standards. Clear? Okay. Then, so here is what is meant by accounting standard and how the accounting standards are applied, and applicability of the accounting standards in India as per the company's rules and as per the ICAI are we discussed. Those are we discussed. Then coming to the accounting standards, the first one is what? Is what? Disclosure of accounting policies. Disclosure of accounting policies, AS1. So remember, in India, ICAI issued 32 accounting standards. 32 accounting standards. Out of that, 2 standards are withdrawn and merged in another standards. Nothing but AS8, Research and Development, withdrawn and merged in Accounting Standard 26, Intangible Assets, and AS6, Depreciation, is withdrawn and merged in AS10, Property, Plant and Equipment. So, in overall, 30 accounting standards are there. 30 accounting standards. Out of that, 3 standards are not notified. So total standards notified by the company's law is nothing but 27 standards only. 27. So this is what we are going to discuss. So accounting standard 1, that is nothing but what? Disclosure of accounting policy. Disclosure of accounting policy. So here, what is meant by accounting policy? So accounting policies are nothing but those are the accounting principles and methods of applying those principles in the preparation and presentation of financial statements. in the preparation and presentation of financial statements. So here, financial statements means already discussed. So there are five components are there. Statement of position, balance sheet, and another one is profit and loss statement and cash flow statement, statement of changes in equity, notes and account is there. So while preparing that financial statement, whatever the accounting principles and methods of applying those principles are followed are called as accounting policies. Those are called as what? Accounting policies. So here there are various accounting policies are there. Various accounting policies are there relating to the some transaction. Some transactions are there where more than one accounting policy is available, more than one accounting policy. For example, coming to the depreciation. So we have number of policies are there like a cycler method is there, a WDV method is there, sum of years digits method is there. In case of inventory, we have FIFO method, weighted average price method, simple average price method is there. In case of the construction contract, we may use percentage of completion method or 100% completion method. So there are number of areas are there where more than one accounting policy is available. More than one accounting policy. Then which accounting policy required to follow? Then accountant has a free hand to follow any accounting policy, but once the accounting policy is selected, it should be followed consistently from the year after year. From the year after year. So, accounting policy is nothing but those accounting principles and the methods of applying those principles in the preparation and the presentation of financial statements is said to be a what? Accounting policy. Accounting policy. Then areas where more than one accounting policy is available. More than one accounting policy is available. So best example is valuation of inventories. Which methods are there? FIFO, weighted average price method, LIFO. LIFO method is there, etc. And valuation of investments. Investments are valued either at cost or NRV or cost or NRV, whichever is less, cost or fair value, whichever is less. In case of construction contracts, in case of construction contract, then we have percentage of completion method or 100% completion method is that. Either we may follow percentage of completion method or 100% completion method is there. Then coming to the fourth one, valuation of fixed assets. General fixed assets are valued at what? Cost, or we may follow what? Revaluation method. We may follow revaluation method. And another one is treatment of foreign exchange loss or gain. The gain or loss on foreign exchange is a transfer to, in some cases we transfer to profit and loss statement, in some cases we defer that exchange loss by transferring to balance sheet. So by transferring to balance, coming to the goodwill, we have average price method, super profit method, and annuity method, capitalization method is there. Capitalization method. Coming to the borrowing cost, in some cases we transfer it to the P&L, some cases we capitalize that amount. So coming to the government grants are there. So in case of revenue grant, we transfer it to the P&L credit side, or we may reduce from the corresponding expense. So in such a way, if you consider the transaction, so where more than one accounting policy is available, more than one accounting policy, we have to select that accounting policy in such a way, so without considering over or undervaluation of assets or liability. Over or undervaluation of assets or liability, because the ultimate objective of preparation of financial statement is nothing but to get true and fair view of the financial results and financial position of the entity. For getting the true and fair view of the financial results and financial position of the entity, so we have to value the assets and liabilities in a proper way. Then for valuation of assets and liabilities in a proper way, you need to select the accounting policy correctly. That's why most important, there is a most importance is there to the selection of accounting policy. Selection of accounting policy. Clear? So accounting policy is nothing but what? Accounting policy is nothing but accounting principles and methods of applying those principles in the preparation and presentation of financial statements. So here we use the words accounting principles. Accounting principles are some cases, it includes what? Some concepts and some conventions, some rules and regulations required to be followed while presenting or while preparing the financial statements of the entity. While preparing the financial statements of the entity. Then coming to the next one, fundamental accounting assumptions. Fundamental accounting assumption. So what is meant by fundamental accounting assumption? So there are number of assumptions taken by the party while preparing financial statements. So while preparing financial statement, like for example, while recording the capital, owner is treated as an outsider. While recording the transactions and events, only monetary transactions are recorded. Non-monetary transactions are not recorded anywhere. So, and assets are generally recorded at the cost price only. So, in such a way, while preparing the financial statement, we took some assumptions. We took some assumptions. But some fundamental assumptions are there required to be followed while preparing financial statement. Those are generally followed by the party in the preparation and presentation of the financial statement. That's why clearly stated disclosure of these fundamental accounting assumptions are not required if they followed. The disclosure of the fundamental accounting assumptions are required to be given in the notes on accounts only if they are not followed. If they are not followed, then what are they? So there are three items are there. One is going concern, consistency, and accrual. Going concern, consistency, and accrual. So what is meant by going concern? Generally, while starting the business, every business assumes the life of the business is perpetual. The life of the business is infinite, and no person expect short-term profit. Every person wants to earn the profit in the long run and in its lifetime from the business. So that's why business is always assumed as a going concern. Business is always assumed as a going concern. If the financial statements are prepared based on this concept, going concern concept, the financial statements are prepared based on this concept, what is the meaning? The business or the management has no intention to close it in nearby future. The management has no intention to close it in nearby future. And the management has no intention to close or to sell major plant of the respected business. So Generally, every business assume the going concern. Every business assume the going concern. If the financial statements are prepared based on that going concern concept, what is that meaning? The management has no intention to sell the respected business in nearby future, or the management has no intention to sell the major plant of the respected business in the nearby future. So if the going concern concept is followed, then assets are shown at cost or book value only. Cost or book value. In some cases, for example, the company, or if the company wants to close in the coming year, then going concern concept is not followed. In that case, at what prices that assets or liabilities are shown? At NRV, net realizable value. So, if the assets and liabilities are shown at net realizable value, that means that business has no intention to continue in the nearby future. So, that party wants to close the business in the nearby future. Okay, so this is what is meant by going concern concept. Going concern concept. Then, second one is relating to consistency. So, as my name said, so you have more than one accounting policy is there in number of areas. Coming to the inventory, coming to the investment or goodwill or fixed assets, etc. If you select any one of the area, then we have more than one accounting policy is there. We have the free hand to select any one of the accounting policies. But the question is, but the point is, you once you select any accounting policy, you have to follow it consistently from the year after year. You have to follow it consistently from the year after year. So, for example, you select a FIFO method for valuation of inventory. You need to follow the FIFO method in the current year, in the next year, in the coming year, in that coming year, or in that coming year, etc. So, in the first year FIFO, second year LIFO, third year simple average, fourth year weighted average, again FIFO, LIFO. So, these patterns are not allowed. So accounting policy, once you select, better to follow it consistently from year after year. That is the point. And the second one, sir, accounting policies cannot be changed up. So no, the change in accounting policy is accepted. Change in accounting policy is also accepted, but in some cases only. But in some cases. So changes in accounting policy is accepted in the following cases. In the following cases. The first one is change is required by any law. Change is required. Change is required by any law for time being enforced. Any law for time being enforced, and change is required by accounting standards or ICAI. Accounting standards or ICAI, and for better presentation of financial statements. So accounting policies can be altered. Accounting policies can be altered, can be changed in the following cases. The change is required by any law for time being enforced, and the change is required by any accounting standard, for ICI, or for better presentation of the financial statement. So in these three cases only, accounting policy can be changed. Accounting policy can be changed. But in the remaining area, change in accounting policy is not accepted. So you have the free hand to select any accounting policy, but once the accounting policy is selected, you have to follow it consistently from the year after year. You have to follow it consistently from the year after year. That is the second one, consistency. Okay. Then the third one is accrual. Accrual stands for, so the transactions and events should be recorded as and when they are incurred. As and when they are incurred, irrespective of the payment or receipt of the cash. So generally there are two methods of an accounting, is the cash basis of an accounting, accrual basis of an accounting. And another one is the hybrid basis of an accounting, that is the third one. In case of cash basis of an accounting, what happened? They record only cash receipts and cash payments, and others are not recorded. But coming to the accrual basis of an accounting, the transactions are recorded as and when they are incurred. As and when they are incurred, those transactions are recorded, whether you receive the cash or not, whether you pay the cash or not. That's why, based on this concept only, we have prepaid, outstanding, receivable, received in advance. These accounts are open only because of one concept, that is called as what? Accrual concept. Accrual concept. So we have to recognize all expenses and losses, incomes and gains as per which concept? Accrual concept only. Okay, these are the three fundamental accounting assumptions. What are they? Going concern, consistency, and accrual. So the disclosure of these three fundamental accounting assumptions, the disclosure of fundamental accounting assumption are required if they are not followed in preparation and presentation of the financial statement. So, disclosure of fundamental accounting assumption is not required if they are followed. The disclosure is required in notes on accounts if they are not followed in the preparation and presentation of financial statements. So how they are disclosed? So we have to give the disclosure relating to how that change has an impact in the profit or in the current year profit or current year loss. So we have to quantity of the change. We have to give the effect of the change in the financial result and in the financial position. Financial position. Okay, so that is about what fundamental accounting assumption. So if the fundamental accounting assumptions are not followed, we have to give the reason why those fundamental accounting assumptions are not followed. Then what is the impact of non-following of those assumptions? We have to give the disclosure relating to those factors in the notes on accounts. In the notes on accounts. This is about what? Fundamental accounting assumptions. Next, this is the change in accounting policies. And the next one. So here already we discussed. So we have number of areas where more than one accounting policy is available. More than one accounting policy is available. And we have the free hand to select any one of the accounting policies. We have the free hand to select any one of the accounting policies. Then what are the factors to be considered while selecting the accounting policy? What are the factors to be considered while selecting the accounting policy? So, factors to be considered while selecting the accounting policy. Three factors are there: prudence, substance over the form, materiality. Prudence, substance over the form, material. So what is meant by prudence? Prudence, the dictionary meaning of the prudence is nothing but what? Estimation. Estimation. Anticipation. Estimation or anticipation. He clearly stated, don't expect or don't anticipate a profit. We can anticipate only loss. So as per prudence, he clearly stated losses can be anticipated, but profits cannot be anticipated. As per what concept? Prudence concept. So what is that meaning? So profits can be anticipated only at the time of realization. But in some cases, we recognize the revenue or we recognize the profits immediately before realization also. So profits also can be anticipated if there is a proper evidence regarding the realization of that amount. So as per what prudence concept? For example, coming to the share certificate. So, for example, company issue the shares. So, at the time of issuing the shares, we receive what? Application money. While receiving application money, we write the journal entry, bank account debited to share application account. Then after verifying the minimum subscription, we allot the shares. When the shares allotted, we write the entry, share application account debited to share capital account. Then next we demand the allotment money. When the allotment money demanded, share allotment account debited to share capital account. That is the journal entry we recorded. So if you observe the pattern of journal entries relating to the share capital, only for application we record receipt entry first, due entry second. But from the allotment onwards, first we write the due entry, later we write the receipt entry. So because initially we don't know how many members purchase the respected shares, we cannot recognize that amount. We don't know how many shares how many applications we are going to receive. But once the shares allotted, we know the list of the members who are liable to pay allotment money, who are liable to pay call money, first call, second call, or final call, etc. So once the amount demanded, how much amount we are going to receive, we can estimate because we have the agreement with the party in the form of share certificate. In the share certificate, company clearly mentioned, as and when the due amount demanded, you have to pay. So that's why we recognize first what? Due entry first, later receipt entry. So, as per the prudence, he clearly stated, anticipate losses, but not the profits. But profits can be anticipated only when we have proper evidence regarding the recovery of that amount. That is the prudence. And current assets like inventory is valued at cost or NRV, whichever is less, as per which concept? Prudence. And all provisions relating to the losses are recognized as per which one? Prudence. Then, second one is substance over the form. So here, substance stands for what? Reality. Form stands for legality. So reality has more priority than the legality. Reality has more priority than the legality. For example, Mr. A purchased the goods from the Mr. B. On what basis? Higher purchase basis. He is the purchaser, he is the vendor. He is what? Purchaser, he is what? Vendor. So generally in case of higher purchase, what happened? At the time of purchase, the possession of the good is transferred. Possession of the good is without transferring the ownership. The ownership of the good is transferred to the buyer only after making the payment of last installment. But in case of hire purchase, at the time of purchase itself, after making the payment of down payment, purchaser record that goods and record that item as an asset in the books of account. He record the asset in his books of account as an asset. So because reality of the transfer, because he used the asset, even though ownership is not there with him, he used the asset. He used the asset for the business purpose. So we have reality of the transaction is more priority, has more priority than the legal formality. Than the legal formality. So we have to consider, so that is called as a substance over the form. For example, we purchase the car and we utilize the car in the current year, and due to the COVID, so that registration process is not happened. Then after 4 or 5 months, that registration was completed. So means registration is not completed in the current year. Registration is completed in the next year. But shall we consider the car in the current year as an asset? Yes, we can consider. Because we utilize the car in the business. So here, incurrence of the transaction has more priority than the legal formality of the transaction. Incurrence of the transaction has more priority than the legal formality. We utilize the car, correct? So only legal formalities are pending. That's all. So based on that, don't consider that item as an asset. That is a foolish thing. So reality of the transaction has more priority than the legal formality. That is stated by what? Substance over the form. And the last one is materiality. So materiality, actually we have one. So financial statement should disclose all material items only. So what is meant by material items? What is meant by material items? Material items are nothing but those items which affect the decision of the users of the financial statement. Those items which affect the decision of the users of the financial statement is called as what? Material item. So if the, for example, decimals are there, decimal. For example, we have the figure of around 2 lakh rupee, 2 lakh point 0005. So is that ignorance of the decimal affected the decision of the user? No. That is an immaterial item. That's why decimals should be rounded off. Decimal should be rounded off. So some small items are there, like for example, we purchase this stationery. We purchase this stationery for rupee. For example, we purchase this staple. Staple purchased for 200 rupee. But actually, Staple provides these services for a period more than one accounting year. As per the definition, it is what? Fixed asset. But we didn't recognize it as a fixed asset. We show it as a expense. We show it as an expense because non-disclosure of that item as an asset in the balance sheet does not affect the decision of the user. So we have to show those items, we have to give the disclosure of those items in the financial statement which affect only decision of the users of the financial statement is called as what? Material item. Is called as what? Material item. And non-material items or immaterial items are not required to be disclosed. So while selecting the accounting policy, we have to consider these three factors. One is prudence, another one is what? Substance over the form, and another one is what? Materiality. Another one is what? Materiality. So coming to the accounting standard one, disclosure of accounting policy. In this standard, we discussed what? Accounting. What is meant by accounting policy? Accounting policy stands for what? Accounting principles and methods of applying those principles in the preparation and presentation of financial statements. And the second one is areas where we have more than one accounting policy, like valuation of inventory and valuation of investment, valuation of goodwill, treatment of foreign exchange loss or gain, and the recognition of fixed assets, and employee benefits treatment, treatment of employee benefit, and construction contracts. These are all covered. And the next one we discussed fundamental accounting assumption. How many fundamental accounting assumptions are there? Three. One is going concern, second one is consistency, third one is approval. These fundamental accounting assumptions are required to be disclosed in any notes on accounts only if they are not followed by way of disclosing the reason for non-disclosure of the respected FAA, fundamental accounting assumption. Next, whether the change in accounting policy is accepted? Yes, in three cases. One is if it is required by law or in any time for time being enforced, or if it is required by accounting standards or ICI, and for better presentation of financial statements. Then factors to be considered in selection of accounting policy. Three factors are there: prudence, substance over the form, and materiality. And the last one is disclosure aspect. Disclosure aspect. So the disclosure of AS1, he clearly stated, disclose all accounting policies at one place. Disclose all accounting policies at one place. At one place. And at one place in notes on accounts, and accounting policies should forming part of financial statements. Should forming part of financial statement. And another one is, so previously we consider one point, selection of accounting policy. So if you select the accounting policy in a wrong way, then what happened? It affects both financial results and financial position of the entity. Inappropriate selection of the accounting policy affect financial results and financial position. It affect income statement as well as position statement. Okay, so this is about what AS1, disclosure of accounting policies. Okay.